Hello everyone, my name is Luke Cunningham, and today I'll be presenting my behavioral economics-based policy proposal, which is on mandating loss-framed simulations to improve insurance decisions. Now, I know that's a mouthful, but what that means essentially is when people make insurance decisions, they tend to not make the correct ones. People are underinsured, people are not insured at all, so we're going to try to basically push people and nudge them into the correct ways. And the central goal of this talk is to explain not just why people underinsure, which something traditional economic models struggle to fully explain, but also to propose a practical, evidence-based solution that could meaningfully increase people taking insurance at the proper amount, reducing long-term financial harm, and improving economic outcomes for millions of people. Before diving into the theory, I just want to establish why this topic matters. Is this really actually a prominent issue? Does this happen to a lot of people? And well, the underinsurance protection gap is not a niche issue. It is a nationwide and global financial vulnerability. Um, However, it's global. I'm going to be focusing data on the US just to narrow it down. 27.6 million Americans have no health insurance at all, according to the 2024 census. 43% of adults are underinsured, meaning that they're paying out-of-pocket costs whenever they go to like the hospital and stuff. 66.5% of all bankruptcies involve medical debt. But even outside of health insurance, this pattern still follows. Only about 30% of homeowners in flood risk carry zones actually have flood insurance through FEMA. After Hurricane Harvey, around only 80% of affected households had no flood insurance. So this means that people see the very small probability of a catastrophe happening, and they say, I'd rather have that pocket change because they have optimism bias and they have a bunch of other things that like, yeah, that's not going to happen to me. And so these statistics tell us two things. Many people are exposed to catastrophic financial risks, and importantly, that expected utility theory cannot fully explain why. And this is where behavioral economics becomes critical. Biases like present bias, optimism bias, probability neglect, and especially loss aversion distort insurance decisions for consumers. So our main question becomes, can structured loss-framed simulations help people form more accurate reference points and ultimately make better insurance decisions? Now we have to look at why people actually underinsure. Even when insurance is affordable and the financial risks are large, people still fail to buy the appropriate amount of coverage, or any coverage for that matter. Behavioral economists have shown that this is not a traditional rational choice problem, but it's a psychological one. Kunruther and Pauly's research shows that people judge risk based on recent personal experience rather than actual probabilities. So they don't like to just look at the statistics and stuff. They judge based on what they've experienced, what they know. And if they haven't actually seen a flood recently or an accident, a medical emergency, they immediately treat the risk as close to zero or at 0% of like happening to them. Polly also highlights that insurance decisions are computationally difficult, which is the contracts are complex and evaluating probability takes effort, and it's very hard to understand everything with insurance and what's actually going on. And when choices feel overwhelming, people often default to just doing nothing because they see that that's the easier solution. And in long run field experiments, Kolstein and Tabakman find that even when insurance is subsidized and clearly explained, demand only increases after individuals experience a payout or witness losses firsthand. So essentially, once they realize it can happen to them, that's when it becomes salient. Together, this tells us that underinsurance isn't caused by bad financial math by people, but is driven by predictable behavioral biases that they have. And that's why we need behavioral policies and tools, not just better pricing. Expected utility theory has been an economic model that has been used for a very long time, and it provides a classic framework for insurance decisions. And under expected utility theory, the individuals assess the probability of a loss, the magnitude of a loss, and the cost of the premium. And then they choose the option that maximizes their personal expected utility. But under these assumptions, expected utility theory predicts strong insurance demand for low probability, high loss risks because the disutility of catastrophic loss should far outweigh the moderate premium. However, Kahneman and Tversky which is the prospect theory people, demonstrated that real human decisions systematically violate these assumptions. People do not evaluate probabilities objectively. They do not consistently maximize their expected utility and do everything that they want to. People have irrational choices that they make, and they often disregard the low probability risks altogether. So the persistent, widespread underinsurance we see in the real world highlights a major disconnect between the rational model and actual behavior, which is why we cannot be using the expected utility theory in this situation. Instead of the expected utility theory, we're going to be looking more at prospect theory. And prospect theory helps explain why expected utility theory fails to predict actual insurance behavior. And we can dumb it down to three core ideas. The first one being reference dependence. People think in terms of gains and losses relative to a reference point, but not their total wealth. This makes premiums feel like certain losses, which are overweighted psychologically. This is why people when they experience something firsthand or they see something firsthand, that becomes their reference point, and so they're more willing to buy insurance once they've seen an accident happen or something. Secondly, there's loss aversion. Losses hurt a lot more than gains feel good for people. So even small premium costs feel very painful, while the possibility of avoiding a disaster feels abstract and distant. This is why most people tend to not get insurance or get a very small amount, because they'd rather have that gain, quote unquote, which is they don't spend the money on it, instead of the loss in the future or potential loss. So they would rather just not. And lastly, probability weighting, which is the most important one. Prospect theory shows that people distort probabilities. So low probabilities like a 0.01% for a disaster to happen are often underweighted, leading people to treat them as if they are practically zero or zero. And this is the most important thing with insurance, as insurance covers for what if scenarios and like accidents and stuff like that. And so people, probability weighting, very low is very unhealthy. And this combination of overweighting the certain loss of the premium, underweighting the potential catastrophic loss, directly predicts chronic underinsurance and leads to repetitive problem of this. Flood insurance is one of the clearest real-world illustrations of probability weighting and loss aversion. Floods cause billions of dollars in damage annually, yet insurance coverage remains extremely low for it. These choices aren't consistent with rational optimization, but they are consistent with misperceived probabilities, optimism bias, which is it won't happen to me, salience bias, which is like memories of past floods. If they weren't very recent, then people won't insure for them, and overweighting the sure cost of premiums. Kuhnreuther and Pauly describe this as behavioral market failure, not caused by pricing, but by misjudgment of risk from people. Health insurance shows the same pattern of underprotection driven by behavioral factors. Specifically today, as we heard, 27 million Americans are uninsured, but 43% are underinsured, and 14 million people in America owe more than $1,000 in medical debt, which means they have to pay out of pocket. Medical debt is the number one type of debt collections nationwide. 2/3 of bankruptcies involve medical expenses, so this means that 2/3 of the bankruptcies could have been avoided if people properly insured or had insurance in the first place. And these outcomes reflect prospect theory dynamics, such as small probabilities of major illnesses being underweighted, people thinking it won't happen to me, premiums also feeling like losses instead of preventing a loss. Deductibles and complexity in insurance can cause decision confusion and fatigue and will ultimately result in people not getting it because it's difficult, people procrastinating or avoiding planning for unpleasant possibilities, and all of this can be predicted by behavioral economics. We know that people in losses will be risky from prospect theory, and so they will take the chance to not pay anything. Framing effects fundamentally shape how people interpret their insurance decisions. Kahneman and Tversky in 1984, their paper about framing, showed that if you present the same information framed as a loss instead of a gain, then the preferences will completely reverse. So like example, right now, insurance is typically framed as a cost or a recurring monthly loss or something optional that you could save money on. But research shows that when insurance is framed as avoiding a catastrophic loss or protecting long-term financial stability or preventing debt, people are far more willing to get insurance. The framing determines whether loss aversion works against or for insurance, and so we need to flip this right now. Dan O'Reilly's work with predictableness and vividness, which, by the way, he's the author of Predictably Irrational, the book that we read, emphasizes that vivid, emotional, concrete information influences decisions far more than abstract statistics. For example, when people hear there's a 0.02% chance that a flood will occur, it feels kind of irrelevant. It's very small and it's not very specific or vivid. But when they see a realistic simulation of their actual home underwater or homes underwater, not even just theirs, or their finances being depleted, or how much they would have to spend after the flood, or their family pictures being destroyed, or their savings exhausted, it becomes emotionally salient for them, and loss aversion would get triggered. And this is why simulations, especially personalized ones, are so powerful. If people understand what is at stake, it becomes much more powerful and they'll be more willing to get insurance. One of the most influential pieces of evidence come from a paper by Kolstein and Tabachman with their multi-year field experiment that showed when insurance is abstract, demand stays low. But when people are exposed to these vivid experiences or simulations, demand increases, which is proven by Dan O'Reilly's point. And a repeated exposure leads to sustained uptake. So if we keep doing this over and over, then people will keep insuring at the appropriate or good amount, which will help a lot of people. And this demonstrates that experiential, visual, and emotionally salient information fundamentally shifts how people perceive risk. So people just need to be nudged in a good direction or need to be presented information in a certain way in order to make them understand what is actually at stake. Based on all this evidence, I propose a policy requiring insurance marketplaces to integrate mandatory loss-framed simulations during the decision-making process. These simulations should show a 10-year projection of wealth with and without the insurance, expected disaster probability and financial consequences if it happened, personalized estimates on their income specifically or their property data, maybe not just their house specifically, but like the area that they're in, loss framed outcomes that highlight what is at risk in a way that is more understandable. And this is good because this policy combines what we've talked about with prospect theory, with behavioral nudges, and empirical field evidence, which separately have all been positive results when used correctly to get people to properly insure. But why would this work? Well, loss frame simulations directly address the biases prospect theory identifies. They make rare losses psychologically immediate, overcoming probability underweighting. They also recenter the reference point from, I'm okay today, I'd rather have the money right now, to I could lose $80,000 next year if I don't spend this little bit of money. And they leverage loss aversion to encourage protective decisions, bettering society. Some of the impacts of this policy that I've discovered would be number one, increase insurance uptake. Empirical studies that we've talked about consistently show that vivid framing increases willingness to insure. And if we consistently keep doing these, then over the years we'll get consistent increase in insurance uptake and probably more people will be influenced by others taking it. Number two, reduce household financial harm, where millions of people each year suffer avoidable financial devastation because of low insurance uptake. So they get completely ruined, but that can be countered if we just nudge them in the correct way. And number three, improved market efficiency. Higher insurance participation spreads risks more effectively and reduces the need for expensive government disaster relief programs. So not as much money spent on, FEMA and all the disaster stuff because the insurances will cover for it. All these outcomes are supported by prospect theory and can be explained in other research articles that I have at the works cited at the end. Another additional benefit is that the insurance markets themselves will become more stable. Low uptake creates what economists call adverse selection, which is that the people who buy insurance are usually the highest risk people, which raises the premiums for everyone because the insurance companies don't want to pay for just the highest risk people, so they're going to increase it so they can keep going. But by increasing participation through better decision tools, we can reduce adverse selection, create healthier pools, and potentially lower premiums in the long run. So insurance companies won't charge as much because they have multiple people, but also that more people will be insured, so it's safer and better for people. Despite all these strong benefits, we still have to consider some of the risks. One of them being the risk of overinsuring, where simulations could scare people into buying unnecessary amounts of coverage, but we have to be careful and balance this. There's also the risk of manipulation, where Thaler and Sunstein in their article emphasize that nudges must be transparent and non coercive, so again, not be used for evil. And the need for standardization is very important to avoid biased or exaggerated simulations. Strict regulatory oversight must be required. So these simulations need to be accurate and not fearmonger people into taking them. Some safeguards we could include to prevent this is like third-party auditing, actuarial verification, clear disclosure of assumptions, and periodic review of, is this still good? Is this still working? These measures ensure that simulations inform rather than manipulate. To conclude, underinsurance is a serious and widespread problem. The root causes are behavioral, not financial. Prospect theory explains why people misjudge low probability risks. Millions of people face unnecessary financial harm because of the biases like optimism. And loss frame simulations provide a practical, evidence backed tool to improve decisions. This policy is low cost, scalable, grounded in behavioral science, and has strong potential in the future to reduce long term financial harm for millions of Americans and globally if it catches on. And finally, here are my works cited.